No big surprises today. The Fed keeping its $85 billion a month bond purchase plan intact. Peter Hug joins me next to talk about the impact on gold. Pete, thanks for joining me on the line.
You're welcome, Daniela.
Pete, so the Fed maintaining its aggressive easing policy stance. Any big surprises here today?
No, I've been in the camp that I think the Fed is going to continue with its bond purchase plan probably throughout 2013, and I'm still in the camp that it may even go into the first half of 2014.
Peter, how important was this news for gold?
Well, I think when the fourth quarter GDP came out at 0.01, it was pretty much a foregone conclusion that Bernanke wasn't going to suggest that he was going to stop his bond purchase program, given the fact that he is looking for an economic recovery, and the fourth quarter obviously didn't bring that to fruition. I'm somewhat skeptical on those GDP numbers. I think it had a lot to do with the fiscal cliff in the fourth quarter. A lot of the drop in GDP was on the defense spending side. Taking that out of the equation, GDP was about 1.5% up in the fourth quarter. Given the uncertainty over the fiscal cliff in the fourth quarter, I expected fourth quarter growth to be below expectations. We'll need to see what happens in the first quarter of this year. I still am on track to believe that the U.S. economy will grow somewhere in the 2.5% range in this year, which I do not think is enough to bring unemployment down to Bernanke's targets, which then again suggests to me that he will continue the bond purchasing until he gets fairly solid evidence that the economy is on a track for recovery.
Peter, when do you think QE might end?
On a specific date, I think he'll start jawboning it first, which I think will possibly develop by the third quarter of this year. The actual action plan is going to be much, much more difficult to implement. If he starts to tighten up on monetary policy, I think it's going to have some serious implications for the stock market. Right now, the stock market is competing against pretty much zero interest rates. And as a result, you have the stock market back to where it started in 2008. You put 10-year rates up at the 5-6% level. I don't anticipate that'll happen this year, but if that trend starts to begin, I think you'll have a serious impediment to the stock market going higher and to growth. So there's a mixed bag here, and I think until it becomes clear, which I don't think will happen until after this year, I still think we're going to be in an easing mode, not only here, but I also think the Europeans are going to, somewhere in the short term, start to lower interest rates on their side as well, because I don't think the economic recovery in Europe is anywhere near solid.
Peter, let's hold that thought now and talk about the correlation between 10-year bond yields and gold. The yield on 10-year bonds is about 2%. Both are seen as a safety play. What should gold be trading at with the 10-year at 2%?
The 10-year bond, what bothers me on that bond was it was trading at about a yield of 6% as little as a month ago, and it's now trading at 2%. It doesn't sound like a lot, but if you're in a long-term bond position, that's a significant increase, in the neighborhood of 25% from a capital depreciation point of view. If you're in that investment, what confused me this morning when I saw the GDP numbers coming out at 0.01 was I expected that bond to trade aggressively below 2, and it didn't. So I'm a little reluctant here to be bullish the metals in the short term. If you remember my comment the last time we spoke I believe it was last Monday, I suggested gold at 1703 was a short. And then yesterday when gold hit the 200-day moving average, that was the cover. Right here in the middle of that range, I'd be hesitant to go long. I'd like to see a confirmation over 1703 before I took a long position on gold. And I'm just a little concerned that this is a trap for the bulls. So, we went short at 1703. We covered at the 200-day moving average yesterday. A little early, it did drop below that moving average during the day. But right now, I'm out of this market until I get some clear direction. And the 1680 range is not a level that I'm either bearish or bullish at.
Peter, we spoke about GDP before, but how concerned are you about those jobs numbers coming out Friday?
Again, I think that's a headline story. I mean, if the job numbers were extremely good, the bears would see that as Bernanke now having a reason, maybe to end his loose monetary policy a bit earlier, which would be negative for the metals. A dismal job report would confirm that the 0.1% GDP in the fourth quarter might be dragging itself into the first quarter of 2013, which would then indicate Bernanke would be more accommodative, maybe for a longer period of time, which would give ammunition to the precious metals bulls. I don't look at one number at a time. I'd like to see a trend. January numbers are very, very difficult. You've got numbers in there that include the Christmas rush. Part-time hirings. I think they're distorted numbers. I'd rather see the accumulation of the first quarter of 2013 to see a trend before I react to one particular number.
Peter, if we do spike and hit 1850, 1900, what's preventing gold from moving higher?
Well, I mean, gold is trades to some extent from a perception and from a sensitivity issue. Everybody, not everybody, but a lot of the experts that expound their positions over the past few weeks have been suggesting that the Fed is going to tighten, that the central bank buying of metals is going to be less in 2013 than in 2012. There's certainly going to be less physical offtake in India. So from a fundamental perspective, supply and demand, you could make a very, very strong case that gold at $1,680 is probably too rich. But if you look at the other argument, the argument that the Europeans are by far not out of the woods, that the U.S. economy is still in serious shape, that you have geopolitical risks exponentially expanding in the Middle East, with Egypt now again, Jordan. I mean, it can take one little trigger point to get gold going. You have issues with the U.S. debt. You have a potential debt downgrade, which was the first major catalyst that moved gold in 2011. That's potentially on the horizon again. So any one of those triggers can get gold up, and once gold starts to gain momentum and gets through certain key levels, it'll start feeding on itself and it'll become a self-fulfilling prophecy. Right now, you've just had too much news that's been sort of counterbalancing that argument.
Right, Peter, I guess what I'm trying to get at is at the 1850, 1900 level, jewelry demand obviously hurts here at those levels. So how much would jewelry demand impede on gold breaking through the 1900 point?
You could make that argument, Daniel. The problem I have with it is when you look at the metals from, say, 2008 through, let's not even go back that far. Let's go 2010 to the current level. I mean, these high prices of metals have been depressing jewelry demand for the past 2 or 3 years. Again, on a supply-demand fundamental point of view, you could make a very strong case that gold is ahead of itself at these levels. And a retracement is certainly in the cards. But you need to look at this more from an emotional perspective. And when I look at that from an emotional perspective, I look at my client base that comes and transacts with Kitco. And normally when you get a topish type of pattern in a market from a supply-demand point of view, at least from an investor's perspective, you see the very, very small investors coming in and buying small amounts of metal at really at any price that is offered to them. And we're certainly not seeing that. In fact, we're seeing the opposite. We're seeing much larger institutional and high net worth individuals buying at these levels. They're still worried. And, they're coming in and buying $1 million, $2 million at a clip as opposed to buying $5,000 worth of silver. And that trend to me indicates that the big money out there is still nervous, and any type of flashpoint could take this market to higher levels and then test potentially the all-time high of August of 2011. The point being, at 1850 or 1925. Does it go higher? I mean, again, you need to look at the dynamics of the market at that time. If gold does manage to get up to those levels and we do start to get some inflationary surges in this market, which I again think is premature, but that will eventually come. Then you map that back to 1980. The last, I'd say 50% of that move in 1980 was an inflation-inspired move. That scenario has not yet developed. When that scenario develops, and I do believe it will, I just don't know when, the upside movement in precious metals will you won't be able to make the argument that it's justified, but it'll happen. It'll be one of those types of things.
We'll see what happens, Peter. For now, wrapping it up, magic number 1703. Again,
as a trader, this market has been relatively easy to trade. So I'm a little worried about being overconfident, but yes, I had that number 1703 a couple of weeks back. It got there twice, couldn't break through it. It was a short. It's logical that you cover at the 200-day moving average, which was yesterday. We're right in the middle of the range right now. Again, I'd rather pay $25 more than be long this market and see it break down through the 200-day moving average and test 1625. So I'm happy with the trade. I'm prepared to sit and wait and wait for some momentum here to get through either the 1703 level or the 200-day moving average on a break of 1650 would be a short down to 1625 in my opinion.
Peter, that's all the time we have for today. Thanks for your thoughts.
Okay, you're welcome, Danielle.
And thanks for watching this edition of For Pete's Sake. You can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.